Silver's price looks volatile, but the real story is happening behind the scenes. In just the past 10 days, Comex rolled over 132 million paper ounces into March. 800 million paper ounces were dumped in a single day to smash price. Zero physical deliveries happened during that smash. India's MCX is pricing a blowout move before 26th November. And LBMA quietly reported another drawdown, with 30-day delays to India. This isn't normal volatility. This is the structure breaking. Let me show you the data. No hype, no conspiracies, just the truth the market can't hide anymore. Silver looks calm at $50, but beneath the surface, every major signal of stress is flashing red. Silver has now run 5 straight years of deficits, between 125 and 200 million ounces short every year. LBMA vaults needed an emergency 58 million ounce injection in October to avoid going empty. SLV now has 57 million unbacked shares, roughly 11% without silver. This is not a balanced market. This is not normal inventory flow. This is a system stretched to breaking point. On November 13th, something shocking happened. Comex traded 160,000 silver futures contracts in one day. That's 800 million paper ounces, more than an entire year of global mine supply, dumped in hours, while physical demand is surging worldwide. Deliveries that day? Zero. This was not price discovery. This was price suppression from a position of weakness. When you must dump 800 million fake ounces just to stop silver from breaking $55, you're out of real silver, and the manipulation is starting to lose control. Now let's look at the most important data of the month. Between November 3rd and November 13th, Comex December open interest reduced from 105,000 to 78,000. Roughly 26,000 contracts vanished. Where did they go? They rolled over into March 2026. And during the same period, March open interest rates from 34,000 to 61,000. Roughly 26,000 contracts added. This is not coincidence. This is a perfect one-to-one rollover. Shorts dodged December delivery and ran to March. Why? Because they know the vaults cannot handle physical. But something even more dangerous is happening before March. It's happening right now. In India, now the world's largest silver importer, something extraordinary is happening. The spot price of silver in Ahmedabad is 159,900 rupees per kilogram, but the November futures linked to global pricing are only 156,900. That's a 3,000 per kilo backwardation, nearly $1 per ounce premium to get silver right now. Silver backwardation is real. On the MCX options chain, traders are piling into strikes of 165,000, 170,000 and even 175,000, all expiring on 26th November. The volumes are huge, the open interest is huge, and the premiums are huge. This only happens when traders expect a violent price move within days. A market in backwardation is a market screaming, "We don't trust future silver, we need physical metal now." This is what a gamma squeeze looks like, because MCX options hedge into Comex, Comex hedges into LBMA, LBMA cannot deliver, India is in backwardation, premiums are already rising, and JP Morgan has told Indian buyers, your silver will be delayed by 30 days. November 26th could become the first rupture, a mini squeeze that forces hedgers to buy aggressively, leading to the short-term technical target of $70 per ounce. This doesn't replace March, it sets up March. While Comex tries to push price down with fake ounces, India is paying premiums for spot. Shanghai is paying premiums for spot. And China has just restricted silver exports after SGE vaults drained 28 million ounces in October. Physical markets are no longer following paper. They are diverging. And divergence always ends the same way. Paper breaks first. And here's the terrifying part. The shorts that rolled from December to March have created a self-destruct timer. Because if silver hits $70 to $100 by March, and it easily can, industrial buyers will stand for delivery. Sovereign funds will stand for delivery. India will stand for delivery. ETFs will stand for delivery. Longs will stand for delivery. And Comex cannot deliver the metal. They will have to do the unthinkable: buy back shorts at any price, settle longs in cash, or shut down the exchange temporarily, or force LBMA to supply silver they don't have, or allow the price to gap vertically. If March fails, the price doesn't go to 60 or 70. It gaps towards the long-term cup and handle target, $600. This is the nuclear scenario, and right now the data shows we are moving towards that really fast. By December, a mini squeeze is possible if backwardation widens or if Comex cannot suppress with paper alone. Expect violent swings. Between January and February, physical premiums will surge, India imports will spike, and Shanghai leads global price. March 2026. This is the deadline that shorts cannot escape. It is the moment when physical demand meets the reality of empty vaults. When paper leverage collapses, silver does not go up slowly. It reprices $10, $20, $50 overnight. And after that, the 50-year cup and handle completes with a target near $670 per ounce. The world is not ready for what silver is about to do, but you are, because you're watching the data. If this helped you see the truth, hit like, share, and subscribe. This is MarketVelugu, Light on Markets.